a portfolio manager at Purpose Investments. So at Purpose, we do take pride in the innovative, forward-looking solutions and thoughtful commentary that we can provide you as the advisor community. And we really thank you for rewarding us with your confidence and partnership. Now, for those of you who are new to Purpose and dialing in for the first time, we were established in 2013 and have accumulated over that time over 23 billion in assets under management. And we really do have a well-rounded lineup to solve for many of your clients' investment objectives. And we're going to hear from a lot of our most popular managers today. Now, Purpose is an employee-owned company with strategic investors as OMERS Pension Plan, Torquest Capital, as well as Allianz, the world's largest insurance provider. So as I mentioned, we've got a comprehensive group of speakers to provide thoughts on the equity markets, fixed income, where they see opportunities, and where the risks lie. Now, before we jump in, we asked you all 3 questions when you registered for the webinar on your comfort level of equities, fixed income, as well as who was going to win the Stanley Cup. And I'm going to start with the Stanley Cup because I'm an Edmonton Oilers fan. And so I hope you're all right because 28% of you predict that Edmonton's going to win. But what was interesting is, we really noted that many of you are very constructive on the equity side of things, feeling pretty comfortable with where things are at, with 52 of you being positive and 39% neutral. It's the fixed income that was very interesting to me and very telling. And I think, the last 5 years, what we've experienced, we really saw that there's very few of you that are very positive on only 32% on fixed income, where many are neutral, which kind of makes sense, and some very negative. So it's appropriate that we have both Sandy and Tom on today to discuss the fixed income space. So it's really been, let's face it, it's been the last couple of years. No wonder everybody's constructive on the markets. We've had 20+% returns in the marketplace, driven predominantly by Mag 7, now being coined as Batman. But with inflation remaining persistent, long rates backing up more than short rates. So now we have a normal yield curve with a 50 basis point spread. Then we've got Bitcoin surging, a new president with control of the House and the Senate, threatening inflationary tariffs, and now we're going to see some change in our own political landscape. So lots to talk about. So I'm going to pass the floor over to Greg Taylor in just a few minutes to provide his thoughts on what he sees, where the opportunities are from a macro perspective, and any concerns maybe we should be aware of as we navigate the market and some of the geopolitical change and uncertainty. Now, before Greg begins, I do want to remind everybody, we do have a question and answer, a Q&A icon at the bottom of your screen. We will take questions after the formal commentary from all the speakers. We'll make sure to get to as many questions as we can, but please enter those questions as we go along through the day and as you have questions for the individual managers. So on that note, Greg, I'm going to turn it over to you, and maybe you can give us a little snippet on what you see going forward in 2025.
Yeah, for sure. Thanks, Kevin, and welcome everyone to our look ahead call. Glad everyone can join us, and lots going on in the market, and good to see some volatility come in to start the year, as we're already a few weeks into it and off to a nice start already for our mini markets. So to start off with some big questions that I've got on markets in general heading into the year that I think are really something that everyone needs to be paying attention to and really trying to figure out just how they think about this and what they look for going forward. So the first one, as Kevin really alluded to, is can the markets do a three-peat? After 2 big years for equities, and in particular with the S&P 500 up over 20% the last 2, I think everyone's trying to see if they can go for 3. It's not just the Kansas City Chiefs going for a three-peat this year. It's the S&P 500, and we'll see if there's any indication there if the Chiefs can get through the Bills and outlook for that point of view. But really, I think it's going to be a tough act to follow it, and seeing to get the equities to go another 20%, it's going to be a big stretch. And I think the big thing there is that valuations are pretty stretched at near record levels. And also, it really to do this, you're not going to get multiple expansion. It's all going to come on the back of earnings growth. So that's going to be the big thing that everyone's watching. Already got a good start to earnings season in the last few days, but earnings are going to be the key going forward. And then the next question we're looking at is just with the big move in US markets and how other markets haven't really done too much. A lot of people are starting to question about whether they should move away from the US, start to look at some of these other markets and really start to get away from being overweight the US markets and maybe even adding some TSX, which has been underinvested for a while. The third one, though, as we all know, and the big thing to focus on is just what is Trump 2.0, how that's going to affect the markets. There's already a lot of questions around tariffs and trade and if this is going to be inflationary or not. So that's the big question heading in. And that, of course, ties into what bond yields are going to do. So inflation and bond yields, all those macro fun topics are going to be something that Thomas and Sandy are going to touch on later. But again, that's going to be a big thing and for markets and how investors need to look at, say, up in 2025. And then, of course, with correlations being high for between equities and fixed income, which has been a topic we've looked at for the last few years, investors continue to look for diversifiers in that. Real assets, including gold, have been something that people have been adding. But of course, the big question that we'll touch on with Nick providing a little more color is whether crypto fits into that bucket as a diversifier or is it a risk asset and something that how that fits in the portfolios. So on to the next slide. Not going to spend too much time looking at a recap of 2024. I think everyone can remember back a few weeks that it really was a good year. Everything seemed to work. We've had equities up over 20% for most North American markets. Bonds had a decent year. I think there were a lot of good pockets and some good opportunities across our fund lineup and fixed income. And then it was also interesting just to see how basically everything worked. When you look at gold up even 20% for 2024, which is rare to see everything working. And I think that's going to be, again, setting up a tough act to follow as we head into 2025. So on to the next slide. Again, putting on valuations, I think this is really what everyone's got to look at because as much as we're positive on equities and we're looking at just the setup being good with President Trump in there, I think the big thing is this valuation. And what we're showing in this slide is really just a setup of just showing where the starting point is on valuation and what the next 10-year return is on equities. And when you look at where we are now entering the year with the S&P 500, a little around 22, 23 times forward earnings, this historically has not been a great starting point for the next 10 years of equities. And really, when you look at it going back to the 80s, when you started looking at investing for this period in time for the next 10 years, your next 10-year return is basically flat. So this, again, is something that I think is in a lot of investors' minds and why we're starting to see investors start to look at more value metrics, get away from some of the crowded Mag 7 trade, and trying to figure out how to step back from some of these valuation measures that are in the markets. On to the next slide. Again, this is tying into when you're looking at equity markets in the US looking expensive. The chart on the right shows the PE of the S&P 500, so US markets. The lines below that, though, are the Canadian market and other international markets. And the disconnect in the valuation between these two is getting pretty attractive. So when you're looking again at starting points, when you're starting to think the valuation of the US market's getting a little stretched, investors are starting to have conversations whether I should start to switch some of that allocation away from the US. Look at other markets, you're getting a better opportunity on a valuation point of view. And also when you look at the slide to the right, you're starting to see some earnings growth kick in these other markets. So for a while, people have written off Europe and international markets because there just hasn't been a lot of earnings growth. We're starting to see that turn and starting to see some improvement in earnings in those markets. So with the valuation starting to show a pretty attractive spread versus US markets, earnings starting to pick up, this is looking like an interesting opportunity, and we're starting to see a lot of investors start to make that switch into these markets. On to the next slide, and this is really why it's important because it really, for the last few years, has been all US. This is looking at the MSCI World Index, and the contribution to the return last year was almost 100% US markets. The rest of the world has not done much for equities, and I think that's where you're starting to see some investors start to say, look, if earnings are picking up, valuations are looking attractive, is it time to diversify my portfolio and start to allocate a little more to international markets? And I think that's going to be a big talking point for the next few months and few years. On to the next slide. Really, the big elephant in the room, of course, for 2025 is Trump 2.0. And the big thing everyone's trying to figure out is, are we going to get a repeat of the first presidency? Remembering back to that period from when he started in 2017, the market was up 70% for his first term. And a lot of investors are starting to say, well, are we going to get a repeat of that? Because those was a pretty good time for equity markets. And it's also important to note when you listen to President Trump and a lot of things he tweets out or says, he really does score himself on the performance of the S&P 500. So when you know what his scoreboard is, what he's focusing on, and it's safe to say this is something that I should really just buy and buy every dip because this is what he wants to do and he wants it higher and he's going to do everything in his power to make it happen. But the problem is when you look at it, the setup's really different this time. What we're showing in this table that we put together is looking at the starting points for the economy, for rates, and for equities, going back to the initial days of his first presidency in 2017, and also going back to how he is now. And it really does start to see that there's some really big differences. The first one is the U.S. economy is in much better shape now than it was back in the start of his first term. And so we're starting at a high level where things are kicking in. There's a lot of stimulus already in the system. And it's harder to figure out what stimulus measures he can put in place to keep things going without setting off inflation. And again, from an equity market point of view, looking at valuations, as we were just talking about in the last few slides, the S&P 500 is already near the top end of its historic valuation range. So again, last time when he started, he was more muted valuations, less of economy that would be more open to stimulus. And also there's little things he could do differently. So I think it's going to be tough to see a repeat of the performance of the US markets over the next 4 terms that will equal or surpass what he did in his first term. But certainly it's something that he's going to attempt to do. And from a rate point of view, I can let Sandy and Thomas talk a little bit more about that. But there's a lot of things that I think he wants to keep the market. But again, the starting point's important, and the starting point this time is a much tougher setup going forward for President Trump to best the market performance from his first time. On to the next slide. Want to touch a little more here on correlations. Again, as we've talked about over the last few years, when we looked at the death of the 60-40 portfolio when nothing was working and then suddenly everything working, the main reason for that is the correlations between equities and fixed income are basically at the highest they've been in a number of years. And with that, investors are looking for parts of diversification. We've seen investors start to tilt towards more private assets, real assets, anything that has less of a correlation provides some diversification. Another one that, again, has worked in the last little bit has been gold. Gold has worked in portfolios. And I think the next step that people are looking at, and I'll allow Nick to talk about this more, is do we look at a world for crypto fitting into this real asset bucket, acting as a diversifier or replacement for gold? And I think that's another big question investors are looking at. Okay, on to the next slide. Really just want to, again, focus on just how the markets are. So given the setup we've got here, it's going to be a tough starting point. But we do think the big thing that's going to be driving it is the bond market and the FX markets, and that's going to set the tone. The best case scenario here that we can look at is having yields peak. That would be basically on the back of a peak of inflation. And that's, I think, really the big thing people are going to need, because if we do get inflation to peak, yields to peak, we might get to be a nice little tailwind for the earnings to get earnings growth going. So first chart I look at every time I come in the morning is the US dollar and see what the Dixie is looking at. That's the chart we've got here. We're already seeing a bit of a pullback in the last few weeks, and I think that's one of the factors that's caused markets to have a decent start to the year. And I do think that's going to be the big thing, because the other thing, if you look back to the first Trump presidency, that he really is a negative dollar person. He's been out talking about trying to lower the US dollar. That will spur on manufacturing, get exports going. And I think this is an important chart for investors to watch going forward, because if we do get the dollar to pull back, that's going to be nice for risk assets and something that investors need to focus on. So to wrap up on the next slide, again, equity markets are coming off 2 huge years, but I think a three-peat is going to be a tough act to follow unless we really do see supercharged earnings growth and market breadth start to increase. And if you're looking for equity exposure, it might be time to start looking at international markets from a valuation point of view, and the fact that earnings are starting to pick up and look a little better. We do think we're going to see increase in volatility. I think that's something we all remembered from the first Trump presidency with volatility in FX and bond markets. And again, from a crypto point of view, I think everyone needs to have a view of crypto and see how it fits in the portfolio, if it does work as a diversifier or a risk asset, and something that can talk more on. But again, I think it's good to have Sandy and Thomas on the call because, again, as much as I'm an equity guy and think equity markets are super interesting, it's really this year going to be seeing what the FX markets and bond markets do, and that'll set the tone for risk assets going forward. So, Kevin, can turn it back to you and to the rest of our lineup.
Great. Thanks, Greg. Those are awesome charts. So just so that everybody knows, we will be sending out an email after this that will wrap up and be a follow-up to this webinar, and we will include this presentation. So all these great charts that our speakers have here, you will get them in your inbox at the conclusion of our webinar here.
Bizarre photo.
So, so Greg, to me, it sounds like it sounds a little bit about maybe cautious optimism in the equity markets right now. I mean, probably we're not going to see a 20% move, and likely it sounds like active management, diversification is kind of the words of the year for 2025. So almost maybe looking like this 1965 to 82 playbook is, higher yields, persistent inflation, surging commodity prices. There might be some opportunities for some diversification. So we're going to jump over to Sandy. And Sandy, we're entering the fifth year since the 10-year Treasury was sub 1%. Traditional bond portfolios have been challenged, to put it mildly. Most, if not all of us, had never really seen a bear market in bonds until now. The last time we saw this kind of activity was in the mid 60s that I just referenced for the 65 to 82 playbook, and that bear market lasted about 17 years. So now we've had two very successful fixed income solutions that advisors have been adding to portfolios, and both portfolio managers, Sandy and Tom, are on to explain what they've done. So we're starting with Sandy, and Sandy and his team manages our credit opportunities as well as our strategic yield funds. Both portfolios did exceptionally well last year. But it's not just about last year. They've really been consistently strong both in healthy and weak markets. So Sandy, you've been very outspoken about the risks to the traditional fixed income market. So maybe you can discuss this thesis, the prevailing risks, and how you feel that you can both thrive and protect us in this market. And then on top of that, maybe you can provide a little bit about your team's philosophy, because I know that's very important to you, because that's really how you make this a repeatable, successful solution. So I'm going to pass it over to you and talk to us about your successful 11 years.
Thanks, Kevin. And thanks everyone for taking the time today. Kevin, you really stole my thunder from the first chart. We have 3 or 4 charts to talk about, but really, you alluded to the fact that we've been through a 40-year bond bull market from pretty much the length of everyone's careers. I mean, I'm not sure that there's anyone on the call that was in the business prior to the bond bull market starting in the 1980s, but you can see it on the chart. And the past 5 years in traditional bonds has really, we've had a horrible time. I don't mean we, I mean traditional bond investors, the asset class. In the last 5 years, the cumulative return from the Canadian universe, the largest ETF, XBB, has been roughly zero. It's been low single digit cumulative over 5 years. So the bond bull market is over and the bear market has started, and that's what you can see on the red line. Next slide, please. So I want to talk about this chart. In my humble opinion, in 2025, this is the most important chart in finance. So just bear with me for a moment. Let me explain what you're looking at. What you're looking at is a chart of annual budget deficits in the US going back to the beginning of the bond bull market, 1980. And What's interesting about this chart is that for a few decades, we had U.S. budget deficits of a few hundred billion, and then Clinton was in office. He actually had a budget surplus for a brief period of time. And then towards the end of the bond bull market, the budget deficit started reaching roughly $1 trillion. And I can't stress to you enough the relationship between this chart and bonds and what is the risk-free rate for the planet in terms of all financial instruments are benchmarked off the US 10-year Treasury yield. I can't stress enough the importance of understanding that relationship because when there's larger budget deficits, they have to be financed by the bond market. Basically, the U.S. government has to borrow money, and where they get it from the bond market. Now, towards the end of the bond bull market, and that's the green shaded area, 2010 to 2020, the global pandemic. During that period, we had roughly $1 trillion budget deficits, but the bond market actually did fine. And not only that, bond yields kept on coming down. And the reason, a huge contributing factor was we had quantitative easing. And quantitative easing is when global central banks, the Fed really started it in early 2009. They create money out of thin air, they print money, whatever you want to call it, to create a bid in the bond market, and they basically buy the bonds and they put them on their balance sheet. So, this whole effect kind of came to a head in the pandemic, where entering the pandemic, roughly half of the government debt on the planet had a negative yield. And at the time, as a bond practitioner, everyone kind of accepted that, oh, actually, yeah, government bonds have negative yields right now. Denmark has negative mortgage rates, which meant that if you lived in Denmark, at the time, you could buy a house. And because rates were negative, the bank would actually send you a check every month to thank you for borrowing the money. The point is that time came to an end because through the pandemic, something appeared called inflation. And when there's inflation, you can't really have central banks printing money anymore because they turn into inflation fighters. And that's kind of the situation we have right now where um, budget deficits in the US are high, and at the same time, inflation is still roughly 3%. So you can't have the central bank printing money. So fast forward to the period at the end of the chart, no more QE. Now we're at a period where there are $2 trillion annual budget deficits in the States as far as the eye can see. And something that's super important I want to say about this chart, these are not our projections. These come straight from the U.S. Congressional Budget Office. So the website is cbo.gov, and I think it's a super interesting read to go on the website and just grab some of the PDFs and read up on budget deficits, but they're not ending. And the U.S. Treasury market globally is only about 25 trillion. So the U.S. government is adding to the pile to the tune of 2 trillion a year in terms of government debt. And one of the things I learned with my very first buy side job. So I had been on the sell side for a long period of time. But after I worked at Bear Stearns, my first buy side job was at a hedge fund in New York. And my boss at the time, his name's Wayne Cooperman. He basically distilled everything, every industry, every investment problem to a supply and demand problem. And, having looked at a lot of cyclical industries where supply demand imbalance of 2 or 3% can move the price, we now have a situation where we have a $25 trillion treasury market, and we're adding a couple trillion to the pile every year. So the conclusion that we have is that we're in the QE period, bond yields were lower than one would have expected. They were lower than fair value because central banks were printing money to buy bonds. We think in the no more QE period, which is basically starting now, you could have a situation where bond yields are actually higher than fair value. And I don't think we're the only ones thinking this. I mean, I would urge you to go Google the thoughts of Ken Griffin, Stan Druckenmiller, Ray Dalio more recently. This is really an issue that's come to the forefront in terms of finance and a risk-free rate. So next slide, please. So as analysts, we find it very important when we're investing to have a view on fair value, because fair value is how we come up with our target price for anything that we're invested in. And when you think about what is the fair value for the risk-free rate, the U.S. 10-year Treasury, it has approximated nominal GDP growth in the States over a few generations, and that's the chart on the left, where you see the dark line is the U.S. 10-year yield, the green line is U.S. nominal GDP growth. And what's important to note is that there's an inflation component in the fair value. You're supposed to get at least the rate of inflation in your risk-free rate. The chart on the right is an even simpler chart. It's basically the fair value, which is the green, is CPI inflation plus 2%. And, the one takeaway from this chart or this page is that in the period from the credit crisis to the pandemic, bond yields were below fair value for that whole period. Why is that? Because, we think QE was a big contributing factor. And now, excuse me, bond yields are roughly fair value, which is in line with nominal GDP growth or in line with CPI plus 200 basis points, call it 5% area. But in the coming decade, we believe because of the supply-demand possible imbalance that bond yields could be higher than fair value. So just to be clear, we're not making a forecast on the 10-year yield. We just think that the forces that were there to drive yields lower between the global credit crisis and the pandemic are not around anymore. And, we kind of have the opposite where we have a force of supply and demand that could drive yields higher than fair value. So just kind of a recap, because as we mentioned, the bond bear market has started already. And this chart is just, a simple chart that just shows you what traditional bond funds have done in Canada during the 5-year period. And we've taken some of the largest actively managed funds, actually the largest actively managed funds in the country. We've also added in the fixed income universe ETF, which is roughly $8 billion. And you can see that their annual returns have been lackluster, have been somewhat volatile. And, our conclusion is that what you really need in your fixed income right now is an alternative credit strategy where you do not rely on rates coming down to make money. You don't rely on rates coming down to produce total return for your clients, but you can produce total return with a lot less risk in equities. That's the whole point of fixed income. So we've showed you in the last 5 years how the Purpose Credit Opportunities Fund has performed against traditional fixed income funds. So the last chart, fixed income alpha, not beta. I mean, this really is relevant with respect to, not just the Purpose Credit Team funds, but also the funds that the Neuberger Berman team runs. You really, when fixed income is challenged, as we think it is right now for possibly a generation, you really need alpha in your funds and not beta. With respect to alternative fixed income, the 3 broad categories would be active non-investment grade fixed income, which is what we do. There could be private credit in there. There could be leverage investment grade corporate debt fund. But what I would want to stress, which is super important, is that our strategies provide your clients with daily NAV, daily liquidity. We're mark to market every single day. We don't mark our own book. And if your high net worth client needs their money back to buy a larger house or whatever they want to do, they can have it over a normal settlement cycle. And with that, I'll turn it back to Kevin. Thanks.
Well, thanks, Sandy. I appreciate you putting a few of the charts on. One of the things that I've done some research, and I did a very interesting research just to take a look at how your fund has done just against the universe. And I built a 50-50 North American equity fund. So I just used the indices, but I used 50% US, 50% Canada. And then I plotted the XBB as well. And the interesting thing, Sandy, was your risk level was in line with the XBB, but your return level was in line just slightly below the equity. So really getting equity-like returns as you've shown on your return charts, but for much less risk. So, those who have partnered with us already in your fund have been incredibly happy, especially over fixed income years. And so we appreciate the conservativeness and the upside opportunity. Thank you. And maybe in our follow-up we'll send that chart as well, just to show the risk return and how it's skewed to the upside with less risk. So next we're going to hear from Thomas Sobanski. Now Thomas, he works more in the investment grade space. He's with Neuberger Berman. For those of you who are not familiar with Neuberger Berman, Neuberger runs over $500 billion worldwide, and so very large organization that we have a great privilege to partner with. And they've been running our global bond fund for the last five and a half years. And Tom and I speak quite often, and the discussion often leads to how we need to change the way we manage our fixed income portfolios. As Sandy mentioned, it's been a 40-year bull market. It used to be just a set it and forget it. You just let the rates go down, we win on the duration trade, we make some gains. But now it's so crucially important to be active in both your credit as well as your duration management when investing in investment grade fixed income. And how they've done so well. So Tom, over to you.
Thanks, Kevin. Happy to be here, and thank you for everyone for joining, and also your partnership over the past 5-6 years as we've managed the Purpose Global Bond Fund. It has not been an easy experience in traditional fixed income. There's definitely no denying that. We've had 400 basis point rise on the U.S. 10-year yield from the lows over the course of the last 5 years, and as Kevin highlighted, and Sandy as well, hasn't been as easy to generate alpha. But we will say that, it just really highlights the fact that you need to have an active manager, and you need to have an active global manager with a presence not only within the U.S. and Canada, but also that's willing to take advantage of opportunities within the Eurozone or Japan or China and other various locations that have really actually pose some great opportunities now that we've had the repricing over the last 4 years. So in terms of what we are seeing currently, and I'm going to start with some macro slides just on the U.S. and what we think on the growth and inflation front, and why we actually starting to think it's a bit more favorable here to be tactically longer duration versus on the shorter side that we were playing back in 2022 and 2021 when we wanted to preserve capital. But ever since we've had the repricing of the U.S. 10-year yield back to 450 basis points, people need to start to remember what the simple break-even calculation comes into play. So, yes, there could be pressure higher in yields, and obviously fiscal deficits are a main driver of that too. Not only in the U.S., but in the U.K., you see pressure there, and I have a slide depicting some of the differences across regions. But, you need a significant amount of repricing higher in order to lose money on your capital with an investment grade fixed income now. So for instance, the Purpose Global Bond Fund right now, which is an investment grade portfolio, is yielding about 6.5%. And with a duration of about 4.5 years currently. And I would consider that to be neutral, slightly overweight. For our fund, that's going to take you, over 100 basis points to offset a potential whole year's worth of yield gains. And not only that, but within Canada too, it doesn't really cost much to actually take some money off the sideline within your cash portfolio and move it into, investment grade, and make sure that you're going to be getting additional yield, especially as we've now moved towards what we perceive to be a neutral rate within the United States that's being priced too high versus our expectations over the long run, which we personally think is going to be about 3.5 to 3.75%. And right now within the United States, the market's pricing neutral rate higher than 4%, which we perceive to be a bit too hawkish, just given the fact that we think inflation's coming down. So what we've been telling to advisors is, it's easy to move cash into the Purpose Global Bond Fund. It's easy to get 3 to 8% type returns. The upside being that you do actually protect yourself if there was to be a recessionary impulse, if there was to be a black swan type event. And on the downside, you're going to get cash-like returns. especially now that we've had these two equity runs back to back plus 20%. Going up in quality also makes sense and locking in some attractive yields. So why we say now is actually starting to be a good time here is when we're looking at the U.S., which really is going to be driving, most risk-free markets and is going to be the biggest driver for capital inflows for fixed income. GDP is not going to be the driver. So we don't think that there's going to be a recession necessarily. So we don't think that, you should be piling into fixed income because you think that duration is going to work materially in your favor. You're going to get 100 to 150 basis point rally, and that's going to be giving you double digit returns. We don't think that that's a probable event. So our growth estimates actually for the United States are going to be slightly higher than the Bloomberg estimates, and we have it projected at about 2.3% on a year-over-year basis versus the roughly 2% that's being projected from Bloomberg. And that's largely going to be due to the fact that the consumer is on solid footing. We haven't seen unemployment rates tick higher. We don't see any of the key factors like overinvestment yet or balance sheet type recessionary pressures on the consumer. Those remain completely fine. Maybe down the road there's going to be an overinvestment pullback within AI, but that's not going to be a 2025 story. We don't think maybe that becomes more of a 2026 scenario, and you hear that in the earnings reports, and that causes some weakness. But the consumer remains fine, and that's going to be driving most of the growth impulse higher for the U.S. for us versus the Bloomberg consensus. And the biggest thing there is going to be real incomes remain positive. Wages are falling, but we still think that they're going to be positive on a real basis. So why are we a bit more positive on duration right now? Why are we increasing duration? And that's largely due to the fact that our inflation forecasts are actually quite favorable. So if we move to the next slide, please, there's three major components that everyone needs to have a forecast for U.S. inflation and largely other regions too within Canada and the Eurozone. What we're expecting, for core goods here on the left chart is a renormalization to about 0%, maybe slightly higher on a year-over-year basis for core goods. And this is also taking into account some potential tariff risk, which is going to largely affect the goods sector. Our view is that the FX component and depreciation that will be seen there will actually offset most of the one-time impact that you're going to get from higher tariff inflation on core goods. And if you were to go back to Trump 1.0, back when he initiated tariffs, it really wasn't borne out in the real data. So this actually doesn't cause us too much concern on the U.S. inflation front. The biggest driver is actually going to be shelter inflation. Now, shelter inflation is always going to be stickier. It's always going to lag real-time data, whether you get it from Zillow, whether you get it from apartmentlist.com. And we think that this is easily going to trend to 3% on a year-over-year basis and get back to pre-pandemic levels, if not even lower. So the Cleveland Fed actually produces an alternative measure called the New Tenant Rent Index. Now, the CPI that's presented on a monthly basis for the United States is lagged because it takes a sample across 6 different panels, and they only update one panel every single month. So you're really going to have the lagged effects from a repricing 5 months ago versus, that's going to be weighing on 80% of the sample. So the new tenants now that are coming into the market are actually having a negative 2% year-over-year rental inflation in the marketplace. So we think that this is now going to start to feed into shelter inflation. You've seen it actually be quite weak in the last couple of prints. So we're getting much more confidence here that the real-time data is actually going to be borne through into the CPI inflation calc. And we've also made up that ground in terms of on a level basis. For instance, as COVID, you have Zillow rents are up 25%. You have apartment list rents are up 25%. CPI is now finally up 25%. It took about 3 years to catch up, but we should be starting to trend with the new leases that are being signed within most markets in the United States, and that's actually below pre-pandemic levels. So this component is going to be driving our thesis in terms of the fact that the Fed's going to hit their inflation target, and you're going to be able to see the Fed cut rates 3 times versus the one time that's being priced in the market right now. And then the chart on the right here shows the core services ex shelter, and that's going to be largely wage driven. One of the other theses behind why we don't think that the reacceleration of inflation story bears much fruit, at least over the near term, It could potentially be an issue as we go forward about 18 months, but near term, we don't see any pressure because wages continue to decelerate. If you look at the employment cost index, which is the Fed's preferred measure, if you look at average hourly earnings, another measure, or if you look at the Atlanta Fed wage tracker, all three of those continue to point downwards on a year-over-year basis. And that's going to drive the core services X shelter component because that's going to be largely wage driven and it's going to be impacting most of the repricings for these categories. I'll also note that two major components of this factor, financial services and portfolio management fees, accounted for a full 0.5% in the year-over-year rate last year. Portfolio management fees completely ties 1-for-1 with the S&P 500. So unless you think that the S&P 500 is going to be up another 20%, and as Greg noted on the call, that's probably not going to happen, or at least is going to be unlikely, that's not going to actually impact inflation materially higher. Insurance costs as well too typically follow motor vehicle costs, and we're seeing that actually trend downward. So we anticipate less pressure there. So a normalization on those two categories, along with the shelter inflation, should easily get to the Fed's 2% target, and that's why we are exhibiting significant confidence, even with a growth profile that's slightly higher than the Bloomberg estimates. So if we go to the next slide here, as Sandy was noting earlier on the call, fiscal budgets and deficits definitely matter. There's no denying that, but I think that is highlighting why Kevin was noting in traditional fixed income, you just can't have it as set it and forget it. You need to have a manager that's going to navigate the market to take advantage of 50 basis point swings in duration and be aggressive with those views, and then also manage on a cross-regional basis where the appropriate exposure needs to be. So if you look at the top chart here, this is showing the last 5 years of budget deficits within the United States, UK, Euro area, Japan, and Canada. The two areas that have had significant budget deficit pressures have been the US and the UK. And not ironically, you see in the bottom chart here, those that have had a 10-year yield move higher over the course of the last few years since the 2022 big negative market repricing in fixed income has been US and UK. If you look at the Euro area, it's actually flat. And if you look at Canada, it's effectively flat since 2022 levels. So this is helping support growth, but it's also, causing pressure on yields, which has fully repriced in our view, at least in the near term, given inflationary pressures. But it is going to be a persistent issue that fixed income managers need to deal with. But we do think that the break even that is being provided with fixed income markets at least starts to be outweighing the negatives, especially when it's relative to cash. So when we're saying move out the yield curve a little bit, move out of cash, that's why we think it's appropriate, because your downside is much more limited, considering the fact that you have such a higher starting yield point within some of these markets. But it is definitely a dynamic that you need to be aware of, and you need to have a manager that's going to consistently be navigating these markets for. And if you look at the next slide here, on the global scale, we're looking at Euro area versus and just Euro area GDP. We highlighted the US and the fact that it's going to be quite robust. Looking at the consumption for the Eurozone, it's actually 50% driven by government expenditures. We don't think that is going to be materially higher this year. And that's why we're actually looking at potentials for Euro area weakness and to re-engage in Eurozone duration, because we think some of the opportunities are there. The fiscal deficits are going to be increasing, especially in areas like France where they already have problems. And you're going to see this weigh on consumption, and they don't have necessarily the appropriate growth profile to materially move inflation higher. So we continue to be overinvested in the Eurozone as an area where we think there's going to be opportunities. And, since I'm getting up on time, I'm going to skip over a few charts here so I don't over-allocate, and I'm happy to go into any of these over the course of, Q&A or follow up with any advisors. But if we go to some of the opportunities that we're seeing here, thank you. If you go back to the next slide, this is actually looking at the Latin America high yield. So emerging markets is an area that we see significant opportunity on the credit side. Latin Latin America, corporate high yields, the pickup is actually quite attractive relative to developed markets, both in investment grade and in high yield. And we're seeing, for instance, spreads are tight everywhere. They're tight in high yield, they're tight in investment grade. However, we haven't seen that tightening effect in Latin America high yield. And we think that this is going to be an area that we could take advantage of. It's actually at about the 50th percentile if you look at it on a 2-decade basis. So we're seeing attractive opportunities here, particularly within Brazil and Colombia. And that's why within the Purpose Global Bond Fund, we have a decent overweight to emerging markets, because we think that the yield pickup is attractive, especially in this environment where spreads are tight just about everywhere you go. And the chart on the right here looks at, the fact that we have cleansed this index quite significantly over the prior few years, with the default rate being significantly higher. But our forecast for the default rates actually could be in line with averages in the 2010 to 2020 era. So we actually are thinking that defaults are going to be benign, especially with the new index being much higher in quality. And that's why we think that this percentile should collapse relative to developed markets. So now if we go to the performance slide here, the next one, please, just showing how Purpose Global Bond Fund has really delivered for clients. Yes, this is going to be having North America tilt, just given the fact that that's where the bulk of the investment opportunities are, particularly within global fixed income. But you can clearly see here that the Purpose Global Bond Fund, yes, has weathered this storm of negative traditional bond returns over the course of the last 5 years by giving a positive 3% return, which is well in excess of the U.S. markets, which is about 5% a year annualized, and then the U.S. and even the Canadian market, which has not experienced as much pressure. We've still been able to materially outperform by over 2.5% on an annualized basis. So moving into active management, moving out of cash, especially at these reprice levels, we think is just going to be where you want to be located within your investment grade fixed income portfolios. And you need to move away from traditionally thinking about how you navigate fixed income markets moving forward, because and interest rate volatility is going to pick up. It's going to be around in that era of 2010 to 2020, where we had quantitative easing and depressed yields that were barely moving at 2 basis points a day. That's going to be over. And you're going to want a manager that's going to be able to take advantage of opportunities, because they're actually going to be more frequent. And it's going to make fixed income a bit more exciting too, to be trading in.
All right, thanks, Tom. Actually, Vanessa, if you could just back up 2 slides. This is probably one of the most important slides. When you talk to an active manager, any active manager you're going to talk to is going to talk about how they perform credit management. They're looking at the best bonds, the best companies out there, and so on. As Sandy showed in one of his charts, he showed about 15 different bond funds that had all struggled throughout. Part of the problem is they set their duration and they leave their duration. And so really with Purpose Global Bond, what we like to look at is we basically call it double active credit. And what do we mean by that? It's active credit management, which, yes, you get from some of your other active managers, but what you also get is active duration management. And I think this is what's going to be one of the most crucial aspects is, everybody might be a good credit manager, but you also have to play the yield curve properly. And that's what Tom and his team have been able to do. And that's where they have added alpha throughout the years and help protect us sometimes when the rates are going down. And Tom, one of the stories, I mean, we've chatted a lot, but one of the times was 2020 during the pandemic correction. It was quite interesting because they played the duration. Actually, you can see it on this chart, how they moved the duration from 1%, or sorry, 1 year duration all the way up to 5 years and back down to 3 in the course of a year. And they were taking advantage of those dislocations that were happening. So I really want to emphasize that this is a double active credit bond fund. This is not your set it and forget it. And so you're really going to get some true active management. And the amazing thing is the management fee is 35 basis points. So you're almost getting passive level pricing with a phenomenally active manager. So, Vanessa, we can move forward. I just wanted to emphasize that because it is crucially important in this kind of fixed income environment. So we're going to switch gears now. We're going to jump from fixed income, which I know was kind of everybody's worry based on our survey, but we're going to move over to the equity side of things because I think really, I mean, we've seen these Mag 7. We've seen such an overloaded return from such a few number of stocks. The question is, can that still happen? So Nick is going to give us a little bit of a perspective, his perspective on these Batman stocks or the Mag 7. So talk a little bit about them. Is it the beginning? Is it the end? Are we in the third or fourth inning? And then give us a little bit of perspective on digital assets. And I will say, the one thing about digital assets, I just recently saw a survey that was done, and it was done in the States, but of 430 advisors, 96% of them, one client asked them about digital assets and crypto. And so if that's the trend, whether we believe in it, whether we or not, we should educate ourselves on it because the last thing you want is somebody else answering these questions to your clients. So maybe Nick, you can just on the sidebar give us a little bit of commentary on crypto as well. So I'll pass it over to Nick to talk about tech and what's driving the markets and a little bit about crypto.
Yeah, for sure. Thanks, Kevin. And there seems to be one of these new acronyms almost every month as names get cycled in and out. But before I get into the prediction portion of this, I really wanted to talk briefly about kind of macro setup, starting with rates. So rates really do have some varying effects on tech stocks. And the common rhetoric here is really a higher rate environment generally leads to these longer duration assets selling off, which makes sense. But I think you have to ask yourself a critical question here in terms of, are rates higher because of inflation or because of strong growth? And 2 weeks ago, we got a softer CPI print and a stronger labor market. And as Thomas alluded to, what we've seen here is really stubbornly strong economic data, which really tells me we're still in this growth stage. And we get mega cap earnings at the end of this month, which I believe will confirm this. Let's also look at what history tells us. If we go back to the kind of the late 1990s, we had 3 years in a row where EPS growth was 15 to 20%, while the 10-year had a 5 or 6 handle in front of it. Leadership in this period was tech, energy, and growth. Gold isn't the best hedge against inflation. Growth equities with strong flat cash flow are. Now, we all know what happened at the end of that period, the dot-com crash. And the reason this time might be different, and I fully recognize how dangerous those words are, is that these top companies really do this time around have incredible free cash flow profiles and have really amassed huge cash balances to the tune where governments can't deploy as much capital that mega cap tech can. And the free cash flow for these mega cap companies last year was north of 300 billion, growing 34% year over year. And they're spending it right now in the right place and the next secular growth lever here, which is AI. So with that being said, I'll get into my 5 predictions here, which really frame my outlook for next year. Some are a bit more obvious and really continuation of themes from last year, while others are really net new and could be coming online in the second half of this year. So the first prediction is that accelerated compute is really going to continue its build out. NVIDIA is going to be the most valuable company in the world for most of the year. So I had pretty good timing on this one when I came out with it a couple of weeks ago as they retook the lead from Apple yesterday. And if we can just go to the next slide here. 2024 was really the year of NVIDIA. So the man leather jacket really took the tech world by storm, really enabling this revolution. And I think you have to make no mistake here. AI companies would still be treading water if they didn't have this parallel processing to do all this math on. So NVIDIA doesn't just sell a chip anymore. They sell an entire accelerated compute system. And the unit of production here has really shifted from a single GPU to an entire data center. And the market really sorted these semiconductors into the 2 buckets, the AI and non-AI companies. AI won and everything else lost. Although I do believe we're still in kind of maybe the 6th or 7th inning of this CapEx build-out cycle, NVIDIA is still a strong buy as long as they hit production targets with Blackwell, continue to push the product cycle cadence with Rubin, and they protect pricing power. If they defend these components, I think NVIDIA will easily be the most valuable company in the world for majority of 2025. But we also saw the market kind of wake up to some of these custom silicon solutions. So these are chips that the hyperscalers like Amazon, Google, Microsoft, and Meta are all building in-house that are really enabled by select partners. And over the second half of the year, we saw some NVIDIA fatigue as it traded a little bit sideways while some of these custom chip designers, particularly Marvell and Broadcom, went on an absolute tear. So while Broadcom and Marvell are particularly benefiting from this hyperscaler build out, I think there's more than enough room for both approaches to win. So I like NVIDIA, I like Marvell, I like Broadcom, also Teradyne, Micron, and TSMC. So before shifting to the next kind of theme, I wanted to really hit on sort of Tuesday's really exciting announcement around Stargate. So this will be a really good segue into this next theme. So the White House really announced this substantial private sector investment in AI with commitments to reach $500 billion. So that's trillion with a T. And this is a deal with OpenAI, Oracle, SoftBank, and MGX that's initially set to deploy about $100 billion off the bat. But to put it into perspective, this is bigger than NASA's Apollo program from the 1960s after adjusting for inflation. So right when everybody thought we're right near the end of this cycle, we get something like this. So we've also got the folks at Davos kind of now letting slip that a lot of this is going to be NVIDIA chips, so really great read-throughs there. But where the segue comes in is really where the White House comes in. So Trump noted in his inauguration speech that we're going to help, he's going to help accelerate the project to really scale production by making emergency declarations to help with the electricity production for the project. And this has really been seen as a key bottleneck as these new data centers get deployed. So if we can just go to the next slide here. So my next prediction here is that the bottleneck really moves to power for next year. So nat gas IPPs now, nuclear later. But why not buy stocks that have an asset portfolio exposed to both? So we've all seen versions of this chart whereby data center electricity consumption as a percentage of total consumption in the US is going to ramp up. Here we've got a very wide range, but you get the idea. And in the early stages of this data center build out, the focus was really on locations like Northern Virginia, Silicon Valley, really optimizing for latency. But now the trend is really shifting towards area with cheaper land and lower energy costs like Texas. Texas took the bulls by the horn. If you see what I did there, earlier this year, what it earmarked $5 billion of low interest loans for about 10 gigawatts in terms of new nat gas generation capacity. And this is really to help meet a lot of these increases. And guess where Stargate is going in Texas. And in this space, I really prefer these vertically integrated IPPs like Vistra and Constellation, which are up 40 and 50% already year to date, so looking a little bit stretched. But they really do have that profile of nat gas, which is going to be that backstop before we can build this nuclear energy out. Just moving to the next slide here in cognizant of time. So my third theme here is that AI goes from model to applications. So the corollary in this chart here is that from mobile internet kind of compute cycle that we had previously, we first had the semis, then the infrastructure build out, and then the application adoption, which came much later, but dominated in terms of long-term value creation. And I think everybody's trying to draw these analogies in terms of how to think about AI distribution and monetization. And the one that I like particularly is an operating system. So these LLMs that OpenAI is building out does a lot of the technical stuff underneath, and you can build a lot of very tailored solutions on top of it to solve specific problems. And much like we had that sort of cloud era SaaS companies disrupt the traditional license and on-prem model, we have some incumbents versus the disruptors here as well. So the incumbents are enterprise SaaS companies like Salesforce, while the disruptors are AI native companies like Harvey, which is an AI company in the legal space that is powered by OpenAI. And the incumbents have distribution, system of record, customer data, and really established systems integration. But the disruptors are really coming at this with an AI native architecture, and they're really rethinking what is and is not necessary in terms of building this out. So you need to see a lot of these incumbents really adapt and shift their business models from subscription to consumption to really survive here. And in this space, I particularly like a lot of the data infrastructure plays because you need a very clean data estate in order to optimize a lot of these solutions. So I like plays in that space. Moving to the next slide. So my fourth theme here is the deregulation of the cryptocurrency environment is really going to usher in this area where we get back to building. So I'm not going to stand here and put a target price on Bitcoin like a lot of people have, but you really have to pay attention to what's going on here, and you have to follow the flows. So the ETF inflows are showing massive inflection as there's now well over 100 billion in AUM across the ETF product sleeve, and this is really causing sort of everyone and their dad to get off zero and allocate to 2% of their portfolio here. And we did a lot of analysis in terms of how this fits into a portfolio. And if you think of historical price performance, you'd obviously think the more is better. But you have to think about it in the context of volatility targeting within client portfolios. And what you get here is really a Sharpe ratio trade-off that starts to significantly plateau around 5 to 7% of an overall allocation at the absolute max when you map this along efficient frontiers and really assume more moderate price appreciation over the longer term. So we really have to watch this and stay tuned here for more deep dive white papers on us in terms of focusing on this area. And so the chart that we can see here is Bitcoin already being bigger than gold in terms of ETF AUM. And the regulatory environment is shifting from this litigate everything to regulate. So when I say deregulation, I don't mean it's going to be the Wild West. What we have to do is create entirely new frameworks that are native to the crypto scene instead of trying to apply these old and antiquated systems when we try to figure out how to regulate this. And yes, there's going to be some wacky stuff like MicroStrategy and all that, but this is getting institutionalized now to the point where you can't ignore it anymore. So I'm not a maximalist, but I'm not a Luddite. And I think you have to pay attention here. So keep it simple, own an ETF. They're safe, they're legal, and you don't need to worry about forgetting a 13-word passphrase or losing your USB key by accident. Just moving to the next slide here. So I think Sandy came out and said he had the most important chart, and he might be right from a macro view. But I believe ROAI is the most important thing to stock-specific fundamentals into next year. And I don't think it's even close. So the Mag 7, as we kind of discussed, firmly in the driver's seat. We all know this. We've seen the same old chart saying that the top companies make up more and more of the total share of the overall index, with some sensationalized headline like concentration like this not seen since the dot-com crisis. And fine. There's still, if you look at it, they make up so much of the major indices. It's because they have the fundamentals to justify it. So they're growing revenue and earnings faster than the rest, and they deserve what they get. These companies account for north of 30% of the market cap in the S&P, but they also account for more than 60% of the economic profit of the S&P. So this seems pretty fair to me. Now, since we kind of know as the Mag 7 goes, so goes the market, let's get to the most important things for these companies is ROAI, so return on artificial intelligence. So mega caps are slated to spend north of 250 billion building these data centers out to do all this fancy AI math on. But if AI revenue and cost savings don't gain significant traction, at least by the end of this year, then there's a wrench in the plan. So by recent estimates, all AI revenue is probably around 15 to 20 billion right now that we can definitively point to. And I think this needs to at least 5x by the end of this year for any of this investment to make sense. So if you look at this chart, this is Morgan Stanley's estimate for Microsoft AI revenue. They have a bull case of 90 billion and a bear case of 10 billion. So that's a pretty wide range here. And there's not a lot of high confidence votes in terms of what's going to happen in this space. But an equal benefit that you have to pay attention to that's not going to be as cut and dry as everything else is the cost saving side. A lot of these mega cap companies are equal parts sellers as they are equal parts buyers as they are sellers of their own AI productivity enhancements. And they can experience significant operating leverage through hiring slowdowns, as we're seeing with some reductions in labor force now, as really you have an army of interns that's now accessible in the form of these AI agents. And the timing here is going to be extremely important because we're going to have CapEx revisions that we see at the end of this month with the earnings period. CapEx revisions are still going up, versus the AI revenue, which doesn't look like enough yet, and the cost savings, which are not as visible yet. These three components are really going to dictate forward EPS revisions, and earnings are the number one predictor of stock price over the longer run. So hence, as goes ROAI, so will go the market here. And just to wrap up, and then we'll take some questions here. I think we're at a really incredibly exciting part of this coming AI wave. And there's a lot of fear earlier that these large language models were plateauing in terms of their LLM benchmarks and efficiency. And that could be the case. But what's happening now is we're shifting from kind of training all these models to where the scaling laws are applied post-training, and because they can reason now and they can think. And there's this time inference scaling that is really unlocking a whole other avenue. Regardless of all this, I think if you stopped all the advancement that we're seeing in AI today and just look at what the existing systems are capable of, I think you would have 2 decades of implementation that needs to be done. So just remember, people still send paper checks. And I do think we have really here a boundless area ahead of us for anyone who can figure out how to harness artificial intelligence. It's going to optimize workflows, spreadsheets, operations, drug discovery, physics breakthroughs, or even just as a companion when you're listening to a podcast and want to understand something better. So incredibly exciting time here. And tech is really at the center of it. And I'll wrap there.
Thanks, Nick. Very insightful. And I know anybody who has used even just Chat GPT, and I know that she's using very rudimentary AI. I mean, it's an amazing increase in productivity. So
Yeah.
it's amazing what we're going to see going forward. So really appreciate the perspectives on AI, and same with Bitcoin. I mean, it's one of those things where there is a potential asymmetric risk return trade-off here where there could be huge. We just saw Bill Fink from BlackRock. He's predicting 700,000. And the CEO of Coinbase is talking about 7 figures. You don't have to put a lot in your portfolio to make a difference in terms of the upside. And if it doesn't work out, if you've only put 1% in, it's it doesn't affect you in a big way. Now, in the interest of time, and one of the questions we did have, Nick. So the fund that Nick manages our Innovators Fund, and he's very active with our Global Innovators portfolio, and managing it with a lot of the stocks that he was just talking about. In the interest of time, just before we end, and just so that I know we've gone a little bit past the 1 o'clock mark, Mountain Time, 3 o'clock Eastern. I just want to highlight a few of the thoughts that we've discussed. One, real assets are likely a place you want to take a look at to diversify some of your portfolios, to give some of that buffer. Maybe we're not going to see a three-peat. Maybe if we do, it'll be a little more muted. The last time we saw commodities where a great buffer was in 2022 when the market was down, S&P was down 18%, and our diversified real asset fund was up double digit in the teens. So something to think about. Fixed income, as we heard, fixed income is going to be challenged. It's going to be challenged because of the deficits. It's going to be challenged with potentially rising rates on the long end. So you need active management. You need alternative credit management, and that's where you can get that from Sandy and Tom. Technology is going to continue to drive the market, as we saw. Any of you who have even dive a little bit into AI, I mean, it's amazing. We're just at the beginning. We haven't even figured out how it can help us. Digital assets are in their infancy. It's not over yet. There's so few people who actually own Bitcoin at this point in time that there's still a lot of opportunity out there. And we're starting to hear, President Trump is talking about it. We just had Cynthia Lummis came out and talked about, a Bitcoin reserve for the US, where they want to mandate that they own 1 million Bitcoin tokens, which would be 5% of the overall scarce supply. And the last thing that can't be emphasized enough, which Greg was talking about, was the active management. So we need to make sure we have active management, not only in our fixed income, but also in our equities. If we do have a playbook very similar to the mid 60s and 70s, 80s, this is where Peter Lynch and Sir John Templeton and Warren Buffett, this is where they made their names, and in active management. And so it's time to turn back to that active management. So I want to take this opportunity to once again thank all of you for your confidence and partnership. We appreciate the time you invested with us today. We'll make sure we get you these slides. Anybody who had questions, we're going to reach out directly to you to answer them. And thank you very much for your time today, and enjoy the rest of your day.